We start with, a kind of a example. So it's always better to first go through some example. Similarly, for stock also, I'll be starting with example. Before going you about the theoretical part of it, it will be covered. I mean, example will cover everything, and then we'll cover the theory behind it. So, first we're talking about that you are an importer. So either you have to be an importer or an exporter. That means either you have to, buy dollars or you have to sell dollars. When I say dollar, it means all other currencies. Now, even if you are either an importer of services or goods, or you are an exporter of goods and services, or whatever, or you anyway require, dollars because for your own, if you are into business or if you are private, this thing individual, you may go to the market and cover yourself. So we start with importer. That means you require dollars. So that means your supplier has supplied goods to you and you are supposed to make a payment after some time. Normally, whenever you import goods, you don't pay immediately. Sometimes you pay immediately. Sometimes you take a time, 3 months, 2 months, 6 months. So we are assuming that you have a time. You're not making a payment immediately on through the spot market, but you have a liability which is going to fall a little later. So because then the time becomes uncertain and you don't know which way the dollar or any currency will go. So you need to hedge yourself. So first we talk about an importer. So assume that, this guy XYZ is an importer and he has to make a payment of $1 lakh. So on 22nd December, which means on 22nd December, I opened my, this thing online site and updated my slide. So on 22nd December 2023, XYZ Limited wished to book its outward remittance for 29th of January 2024, which is worth 1 lakh. Suppose he's going to make a payment on 29th of January. Now, why I chosen 29th January? It happens to be the expiry day. Just to make it simple. Otherwise, it can be any date. Absolutely. So it can be any other day. Once you learn it, then you can always, do whatever you want. It's just to make the thing simpler. I have kept the date of payment as a date of expiry day. Okay, fine. Now we have weekly expiries also. And you can always close your position before the expiry also. Fine. It's not that, you have to close your position only at the time of expiry. You can do it before expiry. Even if your payment is falling on 27th January, you can close it on that day. Okay. So now what will happen in options trade, you are given strike prices. Okay. So in futures, you look at the future price. There is no strike price. In options, you get various strike prices. Okay. So I'm just showing the strike prices. So these are when you open the market, I'll just take you to the market also. After I cover just first part. So you found that these were the, on 29th of January, there were so many things which are available. Okay. Strike price of 80 to 86 rupees dollar. These were the strike prices which are available. So you can choose any. Okay. Now how you are going to choose a particular strike price? That you will learn in this class only. Now, the spot price on 22nd of December was 83 rupees 17 paisa. Okay. So for each strike price, the spot price is same. Now, these are the strike prices, so you have to choose any one of them. Okay. Fine. And there is a premium to each strike price. That means you have to pay a premium here. Okay. Fine. You have to pay a premium to enter into the trade. Okay. And for $1 lakh, the premium, if you choose a strike price of 80, the premium will be 3,19,000, which is a big amount. Okay. You can reduce the premium if you go down to a strike price of say 86, then the premium falls to only 250. Okay. So I told you that in options, like suppose, in options, what happens is that you get a right, but not an obligation to carry out the contract. For example, I gave an example that suppose you're going, you heard that there's a very good movie which is going to come. So you booked your ticket in advance and you spent 500 rupees. Assume that 500 which you have paid is kind of a premium you have paid, okay? But you bought the ticket, okay? Fine. Now, after you are going to watch that movie after 2 weeks. But somebody said the movie is so bad that you can't even spend half an hour in the hall. So what you'll do? You will not go. What you can lose is only the 500 rupees as ticket price, okay? So you have an obligation, you have a right to go and watch the movie on that particular day, but no obligations. If you don't go to the cinema hall and don't watch, what you lose is only the ticket price. Okay. Now, cinema hall is not going to call you up and say, why you are not come, your seat is lying vacant. Nobody is going to question you. Okay. So if you find that movie is good, you're going to watch it. Otherwise, you can let it go. and you just lose your 500. Of course, you can even sell it also, but assume that you can't sell it. So you can lose only 500 rupees of the ticket price per person. Like suppose you booked it for 3, 4. So that much of money you're going to lose. So if movie is not good, then you don't exercise your option. But if the movie is good, you're going to exercise your option and go. Okay. In case you don't exercise the option, you lose only the ticket price, and in options trade, you lose only the premium. Okay. So whatever premium you're paying here, that is going to be your maximum loss. Okay. The other guy who's giving you right, he can lose a game, I mean, any amount. Okay. Depending on which way the dollar goes. So as a call buyer, in options, there are call buyers and put buyers. I'll tell you, explain what is that. So when you buy option, okay, it's called call buy. That means if you're bullish, if you think the dollar is going to go up or a particular stock will go up, okay, as an importer, you just take the opposite position. What you have, underlying position you have. That means, as an importer, I'm short of dollars, isn't it? Because I don't have dollar, I have to pay dollar after some time. So you take a long position in the stock market. So you have a short position in your real transaction because you don't have dollars, you have to pay somebody a dollar, $1 lakh. So you take a long position. Long means buy. So you buy call. Okay? Buy a call. But because if the dollar goes up, you're going to make money. Okay? But in case if you're an exporter, you just do the reverse. Because there, you are going to get dollars, say after 2 months or 3 months. Okay? So that means you're long in dollars. So you take a short position. You buy a put there. So we'll do theoretical part also, but call importers, call exporters, put. That you must remember. Okay. Now, when you go into the stock market, you found that these were the strike prices which are available. Now, there are certain strike prices which are called in the money. Some are called at the money and others are called out of the money. At the last column, it's written OTM, ITM and ATM. ATM is at the money. So wherever the dollar is currently, if you get a strike price very close to that, that is at the money. So if you look at my orange mark, where the strike price is 83.25, the spot price is very near to it. Okay? Or maybe at 83 also, these two prices will be at the money. Okay? Fine. Now, if you choose 80, okay, if you choose 80, what happens is, if the dollar goes, today is 83, if the dollar goes to 85, you make 5 rupees gain. Okay? So this is deep in the money option. आपको 5 रुपए का फायदा हो जाएगा. But if you are going to have 5 rupees of gain, because the dollar is 83, so you have to pay a hefty premium for that. And the premium is 3,19,000. But if you choose more out of the money, like suppose if you choose 86, your profit will start only after 86. So from between 83 rupees to 86, you're not going to make any money. Okay. So only if the dollar goes to 87, you make 1 rupee gain, isn't it? Fine. So that's why the premium is only 250. That's called deep out of the money, the last option. Okay. So just to be very safe, okay, I'll tell you, people can choose deep out of the money or deep in the money, depending upon what kind of strategy they are playing, and we'll also play that very soon. But before we do that, if you are an importer and exporter, if you have an underlying transaction and you're hedging yourself, normally a person will choose very close to the spot rate. Simple as that. जो अभी spot rate चल रहा है, choose that as a price. So choose the strike price which is very close to the spot price. Now I have chosen 83 rupees 25 paisa. I could have chosen 83 also. We can choose even that also. But you have to choose one only as a trade, I mean when you're doing it. So I have chosen 83.25, where the premium is 23 paisa per dollar. So on $1 lakh, I have to cover $1 lakh, I have to pay 23,000 to the other party, who is called the call writer. So I am a call buyer. Other person is called the call writer. Call writer. Now, for example, just to give you an example, suppose if you are taking an insurance of your car. So you are a call buyer and the insurance company is a call writer. Fine. Because he is writing a call for you. If anything happens to your, car or something, there is a damage, he is going to pay. You are paying a premium of say 15,000, 20,000, 30,000, whatever, depending on whatever car. But if there is a total loss and the car, is lost and he has to pay a 10 lakh, money to you because you're taken a cover. So he has an unlimited, loss potential. If suppose there is no claim, he's going to pocket the premium. And normally insurance companies make money. They're into profits. So they collect premium for everyone, okay, and there are very few people who take a claim, okay. But the claim can go as, as good as the price of the car. If suppose your car is, under fire and you lost everything, is stolen and it's untraceable, okay, then the company is going to pay a full value, okay. So call writer is like the insurance company for you, okay. So that guy is providing you an insurance. So some people, we can also buy, can be a call writer. I'll just discuss that. So at the moment, I'm a call buyer. So you can either as a take as a position of call buyer or a call writer. Whatever position suits you, you can take that. So you're taking a call buyer position. In case of importing, you take a call buy position. So you choose a strike price of 83.25, which is very near to the money because the spot price is 83 rupees 17 paisa, the current spot price. Okay, and you pay a premium of 23 paisa to the call writer. Okay, and by doing this, you are saying that I'm going to buy dollars from you. Okay, when up till the expiry of 29th of January 2024. So you get this right. Okay, but no obligation. आपने एक right ले लिया from the call writer that whenever I come to you before on or before 29 January, I can exercise my option and I can buy dollars at 83 rupees 25 paisa. So this is the right what you have got by entering into this contract. Yeah, Mike. हाँ आपकी बात तो समझ आएगी, फिर भी अगर बेटर रहेगा आ जाएगी. 23,000 ऑन कर लो. 23,000 rupees is transacted on the day. The moment I enter the transaction, I have to deposit this 23,000 to the stock exchange, and this money will be relayed to the call writer. He'll get the money in his pocket immediately. Okay, fine. Okay. Now he has to pay a margin money also. That is a different thing because his loss is unlimited. Okay, fine. As in the case of futures, because the call buyer, his ultimate loss can be only 23,000. He has already paid it, isn't it? Okay. Now, so he has to take 100 contracts because each contract size is $1 lakh. Okay. So that means he has to take a position in 100 contracts to cover his hedging position of $1 lakh because each contract is $1,000. Now, I think I had to tell that. I assume that you are knowing it. Okay. So US dollars, euros, and pound. They are all GDP. They are all 1,000 lots. The lot size is 1,000 there. Okay, fine. And for Japanese yen, the lot size is 1 lakh Japanese yen. So it's standardized there. Okay. I think in futures also it was like this only, which I covered. Okay. So he has to take position in 100 lots. Okay, which would mean $1 lakh. So depending upon what, now here your position is exactly $1 lakh. It can be $1 lakh $2,000. So in that case, you take 100 contracts or maybe 101. So in 100 you will be little less hedged, and 101 you will be over hedged. But you can't cover yourself 100% hedging if you have numbers, odd numbers. Okay, fine. So in forward, you can always cover yourself for odd or whatever because you go to the bank and says that I'm going to receive $1 lakh $3,000. So he's going to give you a forward cover for that amount. But in options, it's standardized. Okay. Now, so he'll buy a call option of 100 contracts, which will cover $1 lakh. Okay. And he's going to, he saw the price of 83.25. This was the market price at that time. Okay. Fine. So he chose this. Sorry, this was the strike price. Sorry. And the market price was the premium, which was 23. So whatever premium which was prevailing at that time. Okay. So he chose that, okay. So he could have even, entered a contract and put his own premium. Instead of saying 23 paisa, he could have put 22 paisa also. If he assumed that between, morning till evening, the premium is going to fall because the premium is going to be charged by writers. Okay. And they are also transacting the market. Okay. So there will be a lot of people who are willing to buy dollars or sell dollars or, okay. So the premiums will also keep, changing. Strike price doesn't change, so that they are fixed by the stock exchange. They're given to you. The premiums can change. I'll explain that. Okay. So he has to pay an option premium of 23,000. So in case if you thought that the premium is little too higher, and it may fall for a particular strike price, so you can wait and put a limit order also. Okay. And wait till, suppose you have 3 or 4 days You can always, I mean, do it. You're not in a hurry. So you can just think for when the premium falls and you can. This is the last traded price, okay? So this is the market price. So you said, okay, it's okay for me. Fine. So you entered and paid a 23 rupees premium. We are presuming that, okay? Now, this is the chart which you look at before deciding what premium you are going to pay, which I'm talking about. So you saw that, on where you are, 29 January. So 29th January, you're going to make a payment. So this is an option contract. So the name is, this is the name given for each contract. OPT, USD, INR expiring on 29th of January and strike price of 83.25 and, call option, European option. I'll tell you there is call option. No, India is all European options. So it will be always CE or PE. Okay. In America, it is, maybe any country, it can be American options. Not nothing to do with Europe or America, but something, but India, it's all European. So we'll have CE at the end. And I'm going to explain what is European and American options. But don't be bothered about it because India, we are always following the European options. Okay. Now, then you saw that what was the premium? So, somebody was on the left hand side. आपकी कौन सी फिगर आ रही है ये वाली फाइल ये वाली this side. So there is a bid price. So these are the people who are willing to buy dollars and offer is the people who are willing to sell dollars. They're writers and these are the called buyers. So somebody wanted to pay a premium of 22.50. So if you can put a limit also, though 23 paisa was the last market price, so somebody said I'm willing to pay 22.50 this thing. So he has punched the order. Okay, fine. And there are 873 bid lots and 7 orders are there. That means maybe 7 people. Okay, so they are willing to buy dollars, but they are willing to pay only 0.2250. Then there is some people who are willing to buy at 2225. As the bid goes down, so who will get the priority? The topmost will get the priority. So he's the first man whose order will get executed. The second man is 0.225. He's willing to pay a little less, so he has to wait. Similarly, the last one, he's offering 0.2150. So he has to be the last of the priority. So these are top 5. So there are some more people also which are following, which are not covered. So they are top 5 bids. So just listen and then ask once I'm through. Okay, fine. Now you saw on the sell side. So there was somebody offering 22.2275. Okay, so that means he's going to offer you at 0.227. I should have actually booked 0.227 in my example. But by the time I saw the screen, it was a little late. So I got this screen after I have punched my order. Okay, fine. After I made my slide rather. So there was some person who was willing to, there is a seller of $1 lakh at 0.2275. Okay. Then there are some sellers who are willing to offer at 0.2300. So in that case, who will get the priority? 0.2275. He is selling dollars at a premium of only 0.22. So similarly, if you go down, there will be some people who are offering 0.2375. Now, first I should look at the screen before I punch my order. Okay. Now I see that there are some people who are willing to sell at 0.2275 and I don't have time. Okay. Then I'll say, okay, 0.2275. So the moment I put 0.225, my order will get matched with this guy in the system. If I say 0.2275, okay, my order will get matched with this. Even if I put a limit order, my order will get executed immediately because there's a guy who's willing to sell at 0.275. Okay. But if I say 0.2300, okay, then also my order will get matched. Maybe with 0.2275 because I'm offering more, but there's some people who at the top of the person, he is willing to sell at 0.2275. The stock exchange will immediately give the benefit to me and he will get me 0.2275. Okay, fine. But if I say 0.2250, I have to wait because there is, nobody who's on the sell side is offering 0.225. So that's why these orders are under hang. These are not unexecuted orders which are lying in limbo in the stock exchange. They are not matching. Okay, the moment I enter the screen, so I saw that these orders were there. So I put a figure of 0.23 and there were some people who are willing to sell it. So my order will not take any time to get executed, isn't it? So this is the last traded price of the premium. The premiums can change, fine. If you go to the insurance company and you have to cover insurance of a car, you'll find, at Policy Bazaar, there are people who are willing to give you less price also. And you choose the lowest price, isn't it? Assuming that, everybody is offering you the same, service. So you will choose that. There's always a, a window where you can always lower the premium. So here, there's the same kind of, there's a market for premium also. There are writers who are willing to charge you little more or less. So you have to choose between from whom you are going to, play your hedging risk. Okay. Questions?
This I'm not able to understand this best bid lots 873. One lot is $1,000.
Yeah.
And this number of orders is 7. So
okay. Best bid lots. So these are 873 lots, and the number of orders are 7. Like my order is for 100. This thing. Okay. So 873. My order would be in that part. 873 100 mera ho gaya suppose. But my order is only 1. Okay. So number of order means there are 7 guys who have placed the order for 873. Fine. So if I place the order, maybe that, my order will get executed. But if the orders are, then I may, get, with 2 orders, I may get my order executed also. It may happen like that also. Okay. Suppose it was only say 75, bid lots. Suppose instead of 873 or 73, I am placing 100 lots. So rather on the left hand side, we should look on the sell side. So there are 237 lots. Suppose this figure was only 87, and I am placing the order of 100. So only 87 person is willing to sell at 227. I'll not able to buy everything from this guy. So maybe 87 will get, executed at 0.2275, and rest 13 will get executed at 0.23. Okay, fine.
So as soon as this is executed from this screen, it will the number of orders.
That will get ready. So this will again refurbish it. The moment you're on the screen and you just refresh it, everything will change within a second. Because if there are a lot of people buying or selling, so order getting executed, this figure will keep changing. Okay, I'll take you to the stock exchange a little later. So you paid 23,000 premium. आपने 23,000 रुपए का premium दे दिया, and you have hedged yourself. Okay. Now what happens is, now the day of expiry comes. You have not closed your position. Fine. You could have closed it before also, but assume for simplicity that you have to make a payment in 29. So you'll wait up to 29. You can even do it before also. I'll explain that little later. So on 29th of January 2024, the case 1 scenario. Now assume the dollar rate was 84. Announced the spot rate on that day, announced by RBI. So RBI reference rate is considered for on the rate of expiry. Okay, 84.50. So at what price I paid my strike price? 83.25. So the price has gone up. So I am in a winning position. Okay, how much I am making? First of all, I'm going to exercise my option. Fine, I think the movie is good. I'm going to watch it. So I'm going to exercise my option. Okay, and I'll make a cash profit. 84 rupee 50 paisa minus 83.25 into $1 lakh is 1,25,000, isn't it? And 23 rupees premium I paid. So my total gain is how much? 1 lakh 2. So first, at the start of the order, I paid 23,000 premium, and now I am getting 1,25,000 because the dollar has moved from 83.25 to 84.5. I am sitting on a gain on the day of expiry. Though, I would have, if suppose I would have not covered it, I would have paid, 84.250 to the importer. Not the importer, but to the bank for making $1 lakh. So I was happy that I have taken a hedge position. Okay, because now the 84.50. Otherwise, if I had not taken a hedge, I would have paid almost this amount to the importer on that day, $1 lakh into 84.50. But since I made a money, okay, so I made a gain of 1 lakh 2,000. So what will happen? Now the importer is going to pay 84 lakh 50,000 through his banker. Okay, he is going to charge 84.50 for making the underlying payment, the importer payment, because importer payment falling due on that day. Okay, on that day, forget this gain I have made. Before this gain, I have to make 84 lakh 50,000 payment to my banker, because the bank now says that day has come, you have to make a payment. 84.50 is the thing. But what is my outflow? My outflow is, to the bank I paid 84 lakh 50,000, but I have gained 1 lakh 2,000. So my outflow is only 83 lakh 48,000, isn't it? Dekho, listen. Now what happened was 29th of January. It's a day when the expiry has also happened and my payment has also fallen due. Okay. The banker will call me up. He says, deposit 84 lakh 50,000 because then I can give you dollars so that you can remit it to the supplier. Okay. So I had to immediately make an arrangement to deposit 84 lakh 50,000 in my bank account because that is an underlying transaction. That's a separate transaction. So I'll pay him. But on the same very day, I'll get 1 lakh 2,000 from the stock exchange because I have taken a position which was just the opposite position. What position I have in the import transaction? There I'm losing the money because when the spot rate was only 83 rupees 17 paisa, but today I'm paying at 84 50,000, so I'm losing.
So actual delivery is not taking place in case of options, like just like futures.
No, this is a cash settle. Everything is cash settle. But when you go to the stock market, when you go to Reliance and other stocks, there is some physical also.
Forward we have actual delivery.
हाँ एक्चुअल हाँ फॉरवर्ड में अभी फॉरवर्ड में ही डिलीवरी होती है फ्यूचर्स एंड ऑप्शंस में करेंसी ऑप्शंस में कैश सेटलमेंट स्टॉक ऑप्शंस में थिंग्स चेंज देयर वी विल डिस्कस टुमारो दैट
ट्रांजैक्शन पर एक्सटेंड करते हैं कि वहां से मैं जब मैं एग्जीक्यूट करूंगा कॉल ऑप्शन को
हाँ
हाउ द कैश ट्रांजैक्शन हैपन
हाँ देखो ऐसा है देखो लेट्स गो फ्रॉम दिस सो you're an importer okay when you are going to make a payment on 29th of January that is your underlying position that is between you importer and your bank fine that's something totally different okay so on 29th if I don't cover anything on 29th November whatever is the dollar rate I have to make a payment okay of $1 lakh assume it is going to be 84 rupee 50 paisa so I have to pay 84 lakh 50,000 today the dollar rate is what 83.17 so I'm losing that because the dollar has appreciated and my import bill has gone up if I would have made the payment immediately to the importer I would have paid 83 lakh 17,500 you would have said I don't require any credit you take your money immediately I'm preponing the payment I don't want to lose money because the dollar is expected to go up but here you thought okay I'll cover the risk from the stock exchange let me get the full credit from the supplier and I'll pay him the payment on 29th of January I'm not worried because I've taken a head position but I have to pay 23,000 rupees as a premium cost hedging cost so I paid that okay and now what happens is that you paid that amount and on 29th of January the two things are going to happen one in your actual transaction one in the stock market because this day you're going to settle the import bill okay as well as you are going to settle the expiry you're taken hedging position in the stock exchange so both things will happen simultaneously 84.50 paisa is the rate so you are hit by this rate because the dollar has gone up you have to make more payment for your imports but you are not worried because you have taken hedge position and you have gained that money from here isn't it okay so you made a profit suppose you thought you were just a speculator you would have gained 1 lakh 2,000 you don't have any underlying import transaction by doing this you would have made 1 lakh 2,000 you can be either an importer or you can just be a speculator if you're a speculator you made 1 lakh rupees in a matter of just a couple of months okay दिसंबर में करा था जनवरी में खत्म हो गया एक महीने में ही आपको 1,02,000 का फायदा हो गया पर 100 lots now since you are an importer you have to make a payment of 84 lakh 50,000 so your net outflow will be 83 rupees 48 paisa okay sorry 83 lakh 48,000 so you are hedged at what 83.48 which is what 82.25 strike price plus the premium if you add that is what you're going to get okay so that means you will be in a profit only when your strike price plus the premium when the dollar crosses that amount because the premium is a cost strike price plus the premium उसके बाद आपका प्रॉफिट होना शुरू हो जाएगा so your hedging area is 83.48 हाँ सॉरी वो मैंने वहां पर चेंज नहीं करा ये 83 हाँ 83.25 हो गया गुड So 83.25. Is it okay now? Yeah. I keep changing. So somewhere कोई ना कोई रह ही जाता है. सबसे ऊपर डेट भी बदलनी नहीं होती. But I was looking at that, not missing out anything. But sometimes you miss out something. Okay.
सिंपल स्पेकुलेटर है अगर
हाँ.
तो उसमें पिछले 23,000 मैंने 22 दिसंबर को आउटगो रहा मेरे अकाउंट से और यहाँ पर मैंने क्लोज किया पोजीशन अपना
तो मुझे जो है वो मिल गया क्या कहते हैं 1,25,000 I got 23,000 पहले दिया अब लिया 1,25,000 मिल गया मुझे
वो सीधा कैश सेटल रहेगा ये वाला।
हाँ वो कैश सेटल रहेगा। सो अगर इसको कंप्लीट करेंगे आपको बिल्कुल समझ में आ जाएगी। ओके, नाउ लेट्स से द केस 2, आई विल रीप्ले अगेन। ओके फाइन, डोंट वरी अबाउट इट। सो केस 2, नाउ इट मे हैपन दैट यू आर अनलकी, okay, but you are lucky. As an importer, if the rate drops, you are happy, isn't it? So as an importer you are happy, but as a stock market hedging position you are not unhappy, because the rate has come down to 81.75. so what will happen? You're not going to exercise right. Movie is not going good, you're not going to watch it, and what you lose is 23,000. आपका लॉस मैक्सिमम कितना हो सकता था? प्रीमियम. यू से आई एम नॉट गोइंग टू go and exercise my option, so you lost this. You are going to pay now 81,75,000 on that day to your banker, and he is going to remit $1 lakh to your supplier. So now what is your cost? Which is your 81.7 plus the premium again. Okay, so that means 81,75,000 आपने पेमेंट करी, and the hedging cost is also your cost. अगर आपने hedge नहीं करा होता, you would have got much happier. You have not incurred your 23,000 rupees cost. Just listen to me. You have not, because you are hedging, there's a cost involved, and you are paying the cost. In case if the dollar goes in your, the currency goes in your favor, then you're going to only pay the premium only. Here, the dollar has not appreciated, rupee has appreciated, but you're thinking that the dollar is going to appreciate. Normally it happens like that. But in that particular week, the dollar has actually depreciated, and you are supposed to pay only 81.75. Okay. Fine. So, but normally you would always cover your risks because you know the dollar is going to appreciate. Okay. So you're covered yourself. Is that okay? Is this okay?
गेन वो नहीं होना, 83.25 माइनस 81.75 जो वैल्यू आया, और उसको भी 23,000 माइनस करके वो नेट गेन।
हाँ वो नहीं, ये तो आपने अब ये तो कॉस्ट बन गई ना आपकी. तो वट एवर यू हैव पेड द मनी आउटफ्लो एंड अदर आउटफ्लो 23,000. In this case, what you did was that you had added here 83.25 strike price plus 0.23. Okay, here strike price is not important for you because you are not exercising an option, so you are paying 81.75. Okay, so that is more important. You are going to add the premium, and this will be you are going to pocket the premium, isn't it? Now let's go to this thing. I'll again replay. Okay, and you can watch a video so many times to understand. You have missed out. Now we'll go to